What if I told you a retired couple could pull in $76,000 a year and pay absolutely zero in federal taxes? I'm not talking about some shady offshore scheme. This is 100% legal and it's hiding in plain sight in the tax code. Today, I'm breaking down the exact month-by-month withdrawal strategy that makes this possible, with real numbers, real accounts, and zero fluff. Let's dive in. The framework. Here's the thing most people miss about retirement. It's not just about how much you withdraw. It's about which account you tap, when you tap it, and in what order. Think of retirement like a tax minefield. One wrong step, pulling from the wrong account at the wrong time, and boom, you're handing the IRS thousands of dollars you didn't have to give them. So let's start with the foundation. You've got three types of accounts in retirement. First, tax-deferred accounts like your traditional 401k or traditional IRA. This is money Uncle Sam hasn't taxed yet. He's just waiting for his cut. Second, taxable brokerage accounts. The beautiful thing here is long-term capital gains get special, lower tax rates. And third, tax-free accounts like your Roth IRA. This is the golden goose, money that grows tax-free and comes out tax-free. Understanding these three buckets is everything. The 2026 tax landscape. Now let's talk numbers for 2026 because this is where the magic happens. For married couples, the standard deduction is $32,200. Think of this as a free pass on your first $32,000 of income. But here's where it gets even better for seniors. If you're 65 or older, you each get an additional standard deduction of $1,650. That's an extra $3,300 total for a married couple. But wait, there's more. Through 2028, seniors can get up to $6,000 in bonus deductions, though this phases out starting at $150,000 for married filers. Bottom line, a married couple both over 65 could shield up to $41,500 from taxes. And the cherry on top, the 0% capital gains bracket goes up to $98,900 for married couples in 2026. That means you can pull money from investments and pay nothing in federal taxes up to this amount. This is the playing field we're working with, the real-world example. Let's get practical. Meet our example couple. They're both 67, married, filing jointly, with $1 million portfolio, $200,000 in a brokerage account, $400,000 in a traditional 401k, and $400,000 in a Roth IRA. They want to follow the 4% rule, withdrawing $40,000 a year, but they want to do it monthly. That's $3,333 every month. So here's the optimal strategy. They should pull $2,692 per month from their traditional 401k. That's $32,300 for the year, which perfectly matches their total standard deduction. Every dollar is offset. Tax liability? Zero. Then they pull $642 per month from their brokerage account. That's $7,700 for the year in long-term capital gains, which falls well within that 0% bracket. Tax liability? Zero again. And the Roth IRA? They leave it completely alone. This is their tax-free emergency fund that's still growing. Total yearly income? $40,000. Total federal taxes? Zero. But here's why this strategy is brilliant beyond just paying no taxes. By drawing down the 401k now, they're reducing their future required minimum distributions, which could force them into higher tax brackets later. They're preserving the Roth for emergencies or to pass on tax-free to heirs. And they're using every single dollar of their available deductions. Nothing goes to waste. The Social Security twist. Now, what happens when Social Security enters the picture? Because this is where things get interesting. Let's say this same couple is now collecting Social Security, $1,500 a month each. That's $36,000 a year total. They still want $40,000 from their investments. Here's where you need to avoid what I call the tax torpedo. Social Security benefits can become taxable based on something called provisional income. This is 50% of your Social Security benefits plus your other income. So we need to adjust the strategy. Now they pull $2,000 per month from the 401k. That's $24,000 for the year, and $1,333 per month from the brokerage account, $16,000 for the year. The Roth, still untouched. Here's the math. Their provisional income is $42,000. That's half of their Social Security plus the $24,000 from the 401k. Based on the thresholds, only $5,000 of their Social Security becomes taxable. Their total ordinary income is $29,000. After the standard deduction, they're back to zero tax liability. And the $16,000 from the brokerage account, still in the 0% capital gains bracket. Total income, $76,000. Total federal taxes, still zero. This couple is living on more than the median household income in America and paying absolutely nothing in federal taxes. That's the power of smart withdrawal planning. Now let's cover some curveballs, because retirement isn't one size fits all. If you're subject to required minimum distributions, which start at age 73 for most people, your strategy has to shift. You must take that RMD first, then fill any remaining gaps from other accounts. The problem is, large RMDs can blow up your entire tax efficiency. The solution? Start strategic Roth conversions in your early retirement years before RMDs kick in. And what about market volatility? In down markets, forget everything I just said about withdrawal order. Live off your cash reserves instead. Don't sell investments at a loss. Let the market recover. Then in up markets, use the strategy I outlined and replenish your cash bucket from your gains. Here's something crucial. If you're single, the numbers are different, but the strategy still works. Your standard deduction is $16,100, plus $2,050 if you're 65 or older, plus potentially that $6,000 bonus. The 0% capital gains bracket is $49,450. You can absolutely still achieve zero taxes with smart planning. One more advanced tip. Tax loss harvesting in your brokerage account is like finding money in your couch cushions. Sell underperforming investments, offset your capital gains, or up to $3,000 in ordinary income, then buy a similar but not identical investment to stay in the market. Free tax savings. Common mistakes. Let me hit you with the top 3 mistakes I see. First, the April 1st RMD trap. If you delay your first required minimum distribution until April 1st of the following year, you'll have to take 2 distributions in one tax year. That can bump you into a higher bracket. Take it by December 31st of your first RMD year instead. Second, tapping your Roth first because it's easy access. I get it, but you're killing years of tax-free growth. Roth should be your last resort, not your first choice. And third, the set it and forget it mistake. Tax laws change, your income changes, markets change. Review your withdrawal strategy every single year. Here's what you need to remember. Different accounts have different tax treatments, and order matters. Go tax-deferred, then taxable, then tax-free. 2026 offers some of the most generous deductions for seniors we've seen. And yes, real couples can achieve $0 federal tax bills completely legally. So here's what I want you to do. Take 10 minutes today and map out your 3 account types. Calculate your standard deduction plus any senior bonuses you qualify for. Model your ideal withdrawal strategy or share this with your financial advisor, because every dollar you save in taxes is a dollar for your retirement dreams. Plan smart today, stress way less tomorrow. What's your biggest retirement tax worry? Drop it in the comments. I read every single one. I'll see you in the next video.